name's Toby Russell, and excited to be with you here today. We have about 15 minutes together, and I appreciate you having me with you. I hope you had a good lunch if you're out on Eastern time. I'm actually in San Francisco today, so we on the West Coast here looking at breakfast. Hoping to make this as interactive as we can. Going to be sharing some thoughts about the evolution of retail, payments, and lending. And Robin is going to help us with some Q&A at the end. So if you could, there's an Ask the Speaker box on the right side of your screen. If you want to put in a question, really would encourage that. And we'd be very excited to have this be food for thought that then sparks questions and a bit of a discussion. So I'm mostly going to be speaking from some experience that I've had over the years. In 2007, I started a marketplace for ground travel using mobile apps and BlackBerries called Taxi Magic. We were the first platform that would allow a customer to push a button, have a taxi come pick them up, and then pay for it electronically. After that, I spent some time at Capital One Financial. We were really at the forefront of mobile payments and digital underwriting for consumers, which will inform the talk today, as well as spent the last half decade at Shift.com, building a marketplace and a retail e-commerce experience for customers who want to buy cars online. Now, you might notice most of these are relatively US-centric, so I will caveat by saying, coming to you from the United States and a perspective with that, things may be different in different markets, Canada in particular, but I do think that most of what I'm going to share today is actually quite applicable across the board. And that core conversation starts with the fundamental of how retailers make money and historically how retail and e-commerce has generated funds. In the beginning, as it were, the core of how a retailer would make money is buy goods or potentially services low from a supplier and then sell those at a higher rate to a consumer. And physical footprint was the way to access consumers disproportionately in a pre-digital era. That physical footprint did two things. One, it created a connection with customers and goods, but it also brought a bit of opacity or opaqueness in pricing. It was hard to know for a consumer whether the price that they were seeing on a particular item was better or worse than the price that might exist across town, much less across state or across the country. With the advent of digital, that dynamic changed significantly. The physical footprint became much less important, and visibility to goods and services and the comparison of those becomes much, much easier for consumers. And the result of that tends to be margin compression and some real challenges for retailers moving into the e-commerce space. However, in addition to the challenges, there are real whole new landscapes and opportunities that are brought with digital. The traditional model made it hard, traditional being a brick and mortar physical store, made it hard to gather much data or know the customer that was coming to you. Gathering things like identifying information or consumer behavior, very difficult. But in a digital setting, all of that is available in rich form. In addition, the advent of data science and machine learning to analyze and make sense of that data has come about. And there's an ability to scale in digital in a way that was really unprecedented in the physical footprint approach. You can reach far more consumers, gather far more data, and make sense of that data in a way as never before. The result of that is we're seeing the beginnings of in the payments flow of point of sale lending and retailers beginning to diversify where they're making money, not just on the margin on the physical goods, but beginning to, as I say, make money on the money. You see players like Affirm and others coming into point of sale lending because of that rich data, machine learning, and ability to do real-time underwriting at point of sale, creating a whole new revenue stream, in a sense, business model. Now, this is not new to many areas, but I think instructive is the journey that auto retail had, because auto retail was actually one of the very first to be doing point of sale lending, and I would argue points us to a future that will be instructive for what happens across the board for retail. The reason for that is natural, and that is a consumer who shows up wanting to buy a car from a retailer typically doesn't walk around with $20,000 in their pocket. And the first question they ask after finding the car is, hey, is there lending for that? The auto retailers, even brick and mortar, and now today in the digital space, we're at the cutting edge of building out point of sale lending and actually creating a fairly sophisticated marketplace for lending, taking consumer data, shopping it out to banks, and then coming back with a loan and participating in those economics. We're at an earlier stage of point of sale lending for most of the e-commerce payments flow space, where it tends to be, one underwriter doing that thing and capturing all those assets as opposed to a marketplace dynamic. Do believe that that will evolve, and we will begin to see more marketplace dynamics. But we are seeing it at the early stages. And the analogy here is the consumer comes to check out on a website and is then directed to an Affirm, a Qualify, a Sunbit, and then given a loan. Now, what we're observing, I think, again, in auto retail, which is instructive for where I think broad retail will go, is a new dynamic happening. And that is when that consumer shows up, in this case with a car, and says, hey, I'd like to buy this thing and I need a loan for it. Rather than shopping that loan out to banks, we're beginning to see the retailers verticalize the lending. And that is players like Carvana, CarMax have captive lending capabilities that are now saying, well, we'll take and we'll underwrite you directly for that loan. And then we will package those up as a security and sell that out into the ABS markets, the asset-backed securities markets. Now, this is possible when done at scale, and there is tremendous advantage to doing this at larger scale, and that is cost of capital. We'll talk about that in a moment. But what in fact it does is it takes, in the case of auto, what would otherwise be about half of the economics, the lending part is a significant part of the gross profit for the retailer, becomes even more. You can double the economics by doing vertical lending versus handing that loan off to a bank. And retailers are seeing that and saying, hey, I need to get into the lending business, and being able to capture that value. Again, because there's a lot of compression on the margins that is happening in the selling of the goods. I am hypothesizing, and this is a projection, that is going to happen in other parts of retail as well. That what we're going to increasingly see is in payment flow checkout, we're going to first see more competitive flows for who will be able to get access to that consumer's data and that loan. And then we're actually going to start seeing retailers doing the verticalization of that lending and capturing a much larger piece of the economics of that, again, because of front end, margin compression on the goods and sale, but then being able to, quote, make money on the money, and do that by actually lending and selling into asset-backed securities markets. Now, this is an important dynamic to it, and that is this really creates advantage for larger players because, one, cost of capital is much easier for a larger player. When you're originating in 100 million, 200 million, billion-dollar tranches, your cost of capital comes down, you become much more competitive, and it enables it to go around. And that creates disproportionate advantage for a larger player who's able to do this. I predict, and I think we're going to move to sort of just the slide here because the data on this is a little bit small, but predict that this is going to cause a bit of a flywheel effect. And that is, with the advent of digital into retailing, we saw that front-end margin compression with increasingly transparent prices on the goods themselves. Someone can shop from site to site and find the thing that they want at the lowest price because it's not about being in the physical store anymore. With that increasing competitiveness and compression of margins at point of sale, we are, I think, going to see more and more retailers move into making money on the money. And that is going to be a big advantage for all retailers to be able to create value add service in the payments flow. What we're then going to see is the largest players and those who want to become the largest players begin to verticalize that lending. The verticalization brings, again, huge advantage in terms of being able to originate in large tranches, drop cost of capital, and drive far more economics through the actual making money on the money lending process. In turn, the larger players will be saying, hey, we have an opportunity to do more and more volume. We're going to drive that more and more volume by continuing to lower prices and have low prices and make money on the money, which will then make it harder for smaller players to compete. And ultimately, that cycle will drive, I believe, consolidation in retail spaces one after another as a result of digital. Now, it might be a little bit counterintuitive that the digital advent and the e-commerce revolution would cause consolidation as opposed to, hey, anyone can put up a website and there aren't the kinds of barriers to entry that there were with physical retail and bricks and mortar. But that consolidation, I think, will be the result of the advantages from lending and capital use to take advantage of the compressing margins due to the competitive landscape. With that, I will pause and hand over to Robin to take a look and see if there's questions or anything on folks' minds. The intention of this was to share a point of view and potentially a slightly provocative view of what the future will look like to spark questions and thoughts.
Thanks, Toby. It's a pleasure to be here with you today, and thanks for joining us at the summit, all the way from, looks like sunny San Francisco. I think you said San Francisco, right?
That's much right. Sunnier than Toronto. Sunny day.
So there are a couple of questions. I'll get straight into them. I know we only got a couple of minutes left. The first one is, could you talk about how additional data with payments may change embedded finance? And then how do you think the best practices from the US might translate into other jurisdictions such as Canada?
Two really good questions. I'll say two things that I think will be really valuable for additional data on how embedded finance changes. One is better fraud protection. More data tends to mean better ability to verify, is this person real? Is this transaction legitimate? And therefore, is there fraud or is there not fraud at risk? So that, I think, is a first and an important phase. I actually think that's a building block for the second thing. And that is, I believe, and I'm arguing that embedded finance is going to become more and more verticalized by retailers, which means as that fraud risk and in other forms of risk, credit risk, become more manageable because of the better data, it makes it easier and more accessible for more folks to participate in that risk management. And so I would say that it becomes at first an enablement of embedded finance, and then a democratization, i.e. the retailers being able to do it themselves, causing that verticalization.
Thanks, Toby. And then the other question we had was, in your opinions, what might banks or other financial institutions struggle with when trying to offer embedded finance or lending in the third-party digital channels?
So I think the top thing is, well, given the talk, one of the biggest things I think banks might struggle with is being cut out of the system, disintermediation. That's sort of the number one play there. So in the example of CarMax as a retailer, when CarMax writes the loan for the car, Wells Fargo or Capital One doesn't get access to that loan. And so one of the big struggles is retailers being well positioned to cream skim, take the best assets, put them on their books directly, and then securitize those, or move them however they would like in terms of their monetization path. And so one of the big challenges for banks in this is saying, hey, how do we make sure that we're still getting access to good assets there? And that relates to the second challenge, and that is being able to interface and manage a banking machine via things like APIs and a digital interface. So being competitive by being at the forefront of connectivity while still maintaining the risk management is a challenge for banks. So disintermediation, and then a new landscape, a digital landscape through which they interact with retailers.
Thanks, Toby. And I think that's all we have time for today. But once again, thank you so much for joining us. I really enjoyed that. It's not a topic I know well, but I really did enjoy that. And thanks once again for joining us, and enjoy the rest of the summit.
Thanks so much, Robin. Hope everyone enjoys the rest of the summit today.